maybe we shouldn't be making Roth conversions or contributions, depending on where your income and your expenses lie. So that's something that we specifically individually crunch with our clients and go through those numbers and scenarios trying to work it out. And if it does make sense, over how long a period does it make sense for?
Hello, Peter. Welcome back, everyone. The end of the year is upon us, so this is your friendly reminder. Don't let the IRS keep your money. It is time to start thinking about those year-end tax moves. Most of the money moves that can lower your 2025 tax bill need to happen before December 31st. So this is your checklist. Of course, you should always max out your 401k. The 2025 limit is $23,500 if you are under 50 years old. And if your employer offers, consider increasing your Roth contribution because we still have a few more paychecks to up that money.
Yeah, I don't know about you, Erin, but this year absolutely flew by for me. So, and it's not even time to start thinking about these year-end tax moves. It is time to be executing on them. You should have been thinking about them all year long. And now is crunch time. Now is the critical moment. Be executing on these things. So for your 401k, I actually see some people that take the last few paychecks of the year and significantly up their contributions to get close to those limits. If you've got the ability to do that, even if you might live off of some other money that you've got saved, that's a great way to make some more retirement planning and preparedness progress, is to try to max out those accounts. And the 401k and those employer sponsored plans, unlike IRAs, those contributions must be completed by December 31st and, of course, automatically deducted from your paycheck. So yeah, get those dollars in there if you can. Up those contributions. You mentioned this year's limit, $23,500. We just received the updates for next year, $24,500 for 2026. So again, you should be having these conversations far, far in advance. Go ahead and be ready and set to up those contributions for next year. And I do want to make one quick note reminder as well that I think a lot of people 50 plus know about the catch up. Well, that's going up to $8,000 next year. And there's actually something called a super catch up now. If you are between 60 and 63, next year, that's going to be $11,250. So if you are 50 plus, you could theoretically get $32,500 into that 401k of your money plus whatever company match. And if you are in that super catch-up territory between 60 and 63, that would be $35,750. And another law change for 2026, Erin, catch-up contributions must be made on the Roth side. So I think universally, all 401k plans are now going to have to offer a Roth contribution option in them starting in 2026.
Right. Yes. We just recorded that video for everybody who's watching on YouTube. You can find that on the 2026 upcoming. So next, if you have a high deductible health plan, make sure you are contributing. Try and max it out. Again, that health savings account. This is one of your favorites, Peter, because it is uniquely triple tax advantaged.
Yeah, I love that combination of words altogether. The tax-free money, right? Very few opportunities to say that in life. You can earn the money, put it in the HSA. That's a deduction. You don't pay tax on those dollars. It grows in the account, tax-free. And then if you use it for qualified expenses, healthcare related expenses, and some of those are pretty loose in their definitions. Pretty much anything healthcare related, you can pull that money out and use it for that purpose, tax-free. And then at age 65, you could roll those dollars over to an IRA. Now you lose that last component because at that point in time, it only becomes tax deferred if you pulled it out for any expenses other than those qualified medical expenses. That would be a tax deferred expense if you rolled it over to the IRA. But I see people keeping it in the HSA to continue using it for health expenses because heck, we've got those after 65.
Right. I'm going to do a subset reminder on that one. make sure you're investing the money in your HSA as well.
Yes, I agree with that, but I always also it essentially is an additional investment account that you've got access to with the same kind of retirement advantages. However, I always caution people to keep at least what could potentially be your maximum out of pocket expense in cash.
Mm,
Once you're over and above that maximum out of pocket, yeah, let's invest that money. But you don't want the worst case scenario to happen at just the wrong time and the market's down, and then the money that you save to cover those health expenses that you're going to have to come up with out of pocket has lost value at the same time that you need them.
yeah, good point. My plan mandates at least $1,000 stay in cash, but good point.
Yeah.
Okay, even though you have until the next tax filing deadline, Peter, you just reminded us of this. Max out that Roth IRA.
Yeah, it's a great opportunity, folks, and it's not an opportunity that we're guaranteed to have forever. This is, I think, one of the best investing and growth opportunities where you are keeping more of your money in the long term. As that account grows, it grows tax free, and then you can pull it out for income tax free in the future. It also passes tax free as an inheritance through your legacy. But we're not necessarily guaranteed to have this forever. So take advantage while you can of the opportunity for the Roth IRA. And we've helped at Richon Planning many of our clients get a lot of money into those Roth IRAs. And while you're right, Erin, that you can contribute to the Roth IRA or the IRA until the tax filing deadline, conversions have to happen within the tax year.
Right.
And so we are helping a lot of people make those conversions and kind of playing Bob Barker, the Price is Right. If there is some room left in your tax bracket, we want to try to use up that available room without going over. We want to get as close to it without going over as possible, depending on the situation. Now, we like to crunch the numbers on that because there are some times where the Roth conversion makes a heck of a lot of sense. And then there's other times where maybe we shouldn't be making Roth conversions or contributions, depending on where your income and your expenses lie. So that's something that we specifically individually crunch with our clients and go through those numbers and scenarios trying to work it out. And if it does make sense, over how long a period does it make sense for?
Mm-hmm. Yep, certainly a moving target. All right, number 4, good time to consider selling your stock losers. Why is this?
Well, you can harvest those losses and offset gains. So it's called tax loss harvesting. And at the end of the year, if you've got gains in one position, you've got losses in another position. Nobody likes to see them, but why not utilize the thing that we don't like to see for a greater good? So you can sell out of the gain and sell out of the loss, and those gains and losses essentially wash against each other, and you could get out of those positions, purchase back into them at a later date. You got to wait a period of time, 31 days, if you're going to buy the same positions, but maybe you don't want to get into the same position that already lost you money. So you can sell out of that and get into another one. And Erin, and by the way, this is specifically for non-retirement accounts. So this is not for your IRA, not for your Roth. This is in non-qualified accounts where you would be responsible for gains on growth as capital gains. But by the way, you can also separate out a piece of these accounts and put it in a very small sleeve of a position within your account that is trading on a regular basis, actually with the goal of capturing these losses along the way. And we can mirror an index position and get generally the same returns as the index, but through the separately managed account, through the active trading that we can do for some of our clients that have highly appreciated, highly leveraged, non-qualified investments, we can actually realize more gains along the way and make that a very tax efficient way to unwind those gains or manage the gains on an ongoing basis.
Okay.
Getting a little in the weeds there, Erin, but
I
it's
know
a
that's
great
where you
concept.
love to live. That is where you live, Peter, in the weeds for sure. Last, be tax smart and do good. Donate to charity. Even if you don't itemize, you can still deduct up to $2,000 if you're married.
which is fantastic to get that. But if you do itemize, you can do significantly more than that. And if you're over 70 and a half and you are charitably inclined or tithing, always do that out of your IRA, not out of cash, because that is a tax-free piece of money. Like we talked about with the HSA, truly tax-free money. If you have IRA assets, if you are 70 and a half or above, you can do that QCD, that qualified charitable distribution. And sometimes people don't think of that one until they're 73 because they're taking those RMDs, but you can actually start that process at 70 and a half. So again, if you've hit that magical age, if you are 70 and a half within the year, and you are tithing or charitably inclined, to do it out of your IRA. But again, yeah, to your point, Erin, an additional, even if you take the standard deduction, charitable donations up to $2,000. And then if you do itemize, you can deduct significantly more than that. And there are ways that you could do up to $100,000 with the QCD per year.
Much more tax efficient than the collection plate. And again, the charity is still helped and gets all that money, which is lovely. Just a win-win for everybody.
Absolutely. And by the time you are required to take those minimum distributions, it checks that box as well. So it's a triple win, win.
Right. And then also a good reminder for those required minimum distributions, which, Peter, as you said, this needs to be a part of our year-long plan, but this video is especially made for all of our favorite procrastinators out there.
Well, and I'm glad you bring that up. Yes, absolutely. Like it is past time to get those orders in for this year. But they did also change the rules on RMDs last year. And it's important for everyone to know that the first money out of your qualified accounts is considered the RMD. And this is important for those who are of RMD age, obviously, but if anybody's taking a rollover or wanting to do that QCD, like you should move those up and make sure that you are doing this properly. If you were to take a 401k rollover, for example, and you were supposed to take the RMD, well, now that rollover actually counts as the RMD. It could get you into just a messy situation here where you've got penalties where you could avoid them easily and unintended consequences. So just make sure that you're aware that the first money out of a qualified account is now going to be considered the RMD.
Okay. Yes. And again, it is late November as we record this video, Peter, which means it's also
past time.
Yes, but it's a great time to start thinking for 2026, right? So if somebody wants to sit down with you, Peter, get ahead of the game for the year ahead or talk about maybe some last minute deductions for this year, what's the best way to reach you?
Give me a call at Richon Planning, 919-300-5886, 919-300-5886. And I hear the comment a lot, hey, my financial person doesn't mention taxes at all. If I ask about taxes, tells me that's not their area. And I do not file taxes. I am not an accountant nor a CPA, but when making financial recommendations, I better understand the tax implications that are involved and then run that by the accountant or CPA before we execute on things. But you should also have forward-thinking, proactive people on your team and in your corner. And that's why taxes is one of the pillars of the optimized retirement plan that we put together for listeners and viewers of the show. So if you'd like to get your optimized retirement plan put together, looking at income, investments, taxes, healthcare, legacy, with a forward-looking, proactive approach, your goals in mind, diversified strategies to help you achieve those goals, give me a call at Richon Planning, 919-300-5886, 919-300-5886. There's also a little schedule button on our website right at the top right corner, and you can schedule a phone call or a virtual meeting or an in-person meeting if you'd like to do it that way. RichonPlanning.com. It looks like richonplanning.com.
Great. Peter, thank you.
Thank you, Erin. Hey folks, Peter Richon here with Richon Planning. So glad that you are enjoying the podcast, Planning Matters Radio. You know, one of the tools that we've put out there that people really seem to appreciate and really are finding of value is at 919retired.com. It is your retirement tax bill calculator. If you've got any kind of retirement account, your tax deferred 401k or IRA, this is the website, this is the resource where you can go, you can plug in your own numbers, your information, you can slide the tool calculator up and down for your tax rate or your amount of savings and see what your tax bill is likely to be if you default and defer to the IRS's plan versus what you could potentially bring that tax bill down to. A lot of times it is a very significant savings. So if you have not yet, go to the website 919retired.com, run your numbers on the retirement tax bill calculator.
This has been Planning Matters Radio.
The content of this radio show is provided for informational purposes only and is not a solicitation or recommendation of any investment strategy. You are encouraged to seek investment, tax, or legal advice from an independent professional advisor. Any investments and/or investment strategies mentioned involve risk, including the possible loss of principal. Advisory services offered through Brookzone Capital Management, a registered investment advisor.
Fiduciary duty extends solely to investment advisory advice and does not extend to other activities such as insurance or broker-dealer services. Advisory clients are charged a quarterly fee for assets under management, while insurance products pay a commission, which may result in a conflict of interest regarding compensation.